Hello, everyone, and welcome to another edition of the Smart Investor Market Update. And this update is brought to you by smartinvestorcentral.com. I hope you all had a very good weekend and found it very relaxing. But we are back, and the markets opened to the downside. The S&P 500 was down on the day and closed at 2105. And I'm going to speak about what technical what's a technical picture of the market and why the market was down today. I'm also going to take a look at gold and Apple stock. I know we have a lot of interest in those two markets, so we're going to take a detailed look at those markets. But okay, so the major market mover of the day was the FTSE index that opened up the session at 68.85 and closed at 7,046 on the high. And UK markets were very strong. The UK election was just completed, and the market seemed to like the result that happened. The British pound was also strong on the day, clearing resistance in the 155.85. No, the actual resistance point was 155.52. So the market cleared the 155.52 resistance and the British pound versus the US dollar. So Britain was rallying today. Okay, so to get back to the S&P 500, let's take a detailed look at the technical market update. We're currently in a consolidation pattern, as you can see here. And for those of you who are listening to this alert, what you can do is go to smartinvestorcentral.com and watch the video broadcast. Okay, so we're in a triangular consolidation on the S&P 500. That is why the market ranges have been so tight over the last couple of days. And that's why the market is whipsawing. Some days they're up, some days the market is down. But if you take a look at the chart, the market is not really moving much in terms of direction. It's just going in these tight ranges. And what normally happens in these consolidation patterns is that the market eventually will break out of the consolidation either towards upside or towards the downside. I can say that the breakout normally occurs in the direction in which the previous trend was. So in this instance, we're in an uptrend, and I would say 8 out of 10 times the market will break to the upside if we're entering from an uptrend. If we're entering from a downtrend, the market normally breaks to the downside. Now, I'm not saying definitively the market will break to the upside, but that's why I said 8 in 10 chances. That's why 2 chances in 10 the market will break down. So we'll just have to see which direction this market will break. But in terms of a technical level, if the market closes below the 2049 level, that could be fairly bearish for the market. And if we do close below the 1950 level, that will be even more bearish for the market. And if that happens, you would have to probably consider some more defensive plays in the S&P 500. Taking a look at the Dow Jones Industrial Average, we have a similar consolidation pattern that the market is in, with support at 17,600 and resistance is currently at 18,200. And also the previous high that was made in the Dow of 18,288. Remember, because what I'm seeing is a lot of forecasts to say that the market is at a top, but the market has not shown signs that it's topping out just yet. The signs that the market is topping out, let the price action determine if the market is at a top or isn't at a top. Don't be fooled by the media. Don't be fooled by a lot of newsletters out there that seem to want to predict doom and gloom. When the market starts to decline, you'll see it reflected on a chart. And if when you see it reflected on a chart, that's the time to take action. Okay, so this market is still in a consolidation pattern. As I said, support at 17,600 and longer term support down at the 17,000 level. Okay, looking at the Nasdaq. Now the Nasdaq is not in a consolidation pattern, but hasn't really moved much over the last couple of days in terms of direction. And we're still below the all important, all psychological level of 5,000. No, the previous high, was 4,816. That was made in the glory days of the year 2000. We're now in 2015. So that's 15 years ago. The market was at 4,800. The high that was printed for the market was at 4,816. Okay, so we're still below that level, and I suspect the market is just it's acting like a magnet. The market just wants to eclipse the old high or even reach the old high. So it will be very interesting in the next couple of days to see if the market can actually trade above the old high. So the Nasdaq is definitely a market to look out for. Now on the day, the dollar was up slightly on the day. The dollar index is finding support in the 9,400 or the $94 level on the dollar index, and it's currently at critical support. So we have critical support at 94 down to 93.25 on the dollar index. So we wait to see if the markets can trade below the critical support. If it does, we'll see more selling in the dollar. And just remember, folks, we are coming up on a dollar that has been in a rally for the last 6 or 7 months or so. So it's not all surprising that the market will take a breather. Now let's take a detailed look at the gold market. And for those of you who are watching or can see the charts, I remember to see the charts, smartinvestorcentral.com, and you can go to the video market updates. Okay, we are in a consolidation pattern between 1220 and 1180. 1220 and 1180. Okay, so the market is in a channel, and I suspect if it closes above the 1220 level, we could see a further rally in gold. But if it closes below the 1180 level on a daily basis, if the market closes below that level, we could see further selling and a retest of support down at 1132. That's on the cash market. The low is 1132, and if we close below the 1180 level, we could see a retest of that level. So at this moment, I don't see gold is in is in really no man's land, and it's certainly not in a bull market. And if I was to say what is a bias on the market, the bias is certainly still down, because the market peaked out in 2011, and ever since the market peaked in 2011, it has been a series of lower highs and lower lows for the gold market. Okay, so I'll turn my attention now to Apple, stock of Apple. What's happening in Apple? Apple is reflecting the broader S&P 500. Now, looking at the chart, there is good support at the 121 level. So I can draw consolidation here. But if the market breaks below this 121 level and closes below, we could see a further correction down to the 115 level in Apple. Uh, just taking a look at now, for those of you who hold Apple on a longer term basis, if it closes below 105, that would signify to me that we could be in for a larger pullback. So the first clue of weakness in this market is if we close below 121, and if we close below 105, that would be almost a 20% decline from here. Then we could see a larger sell-off in the stock of Apple. On the upside, if the market was able to clear the 135 all-time high, then we could see more gains in Apple. Now, a stock that I highlighted last week was Data, the ticker symbol DATA, and the market had a huge update on Friday, and I wanted to see if we're getting some follow through in the market. And up to this point, the market was up on the day, but did not close above the high of the previous breakout point. And when I'm invested or trading in bricks, I like to see the market close above the high of the breakout candle. And support in this market is down at 90, all the way down at the $90 level. Okay, so remember the reason, and if you notice that these market updates are all looking at the charts, they're all looking at what's actually happening in the markets. Too often people get into the mode of reading company earnings and looking at fundamental data, and then thinking that that information will translate into the price of a particular stock or a particular market. And when investors invest like that, they get themselves into trouble, because just because a company's fundamentals are good, that doesn't necessarily mean the stock will rally. In order for a stock or for any market to rally, there needs to be money, there needs to be capital behind that move. And if the capital is not buying that particular stock, no matter how good the fundamentals are, that stock won't move. So anytime someone tells you to look at the fundamentals, and the reason to buy a stock is because the fundamentals are good, you need to first check the price action on the chart. And it applies in opposite direction. I mean, look at the 2000 bull market. Stocks were flying high with no fundamentals. The reason why they were flying high is that there was demand out there. The smart money or the capital was behind the move, pumped up the stocks, bought a lot of the stocks, and then when they found out they were empty suits, then they dumped the stocks. But still, a lot of money was made in those up markets, because, again, just because the stock was weak fundamentally, that didn't necessarily mean that the market couldn't rise. So that lesson is applied when you're investing in the stock market. And I can tell you, no one tells you this. I would say 97% of advisory services out there would never tell you that. And if you don't believe me, just read popular analysis of markets, and you rarely hear that you must take a look at what is actually happening on the charts and ignore the fundamentals. Okay, so once again, thank you very much for listening. And if you want detailed market updates, go to smartinvestorcentral.com. And if you follow these alerts, you will be on top of the markets, and you'll know more than most investors know about the direction of the stock market. So once again, thank you very much. And this is Beyond. Have a good day.